Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's January 23rd, and we're now joined by Adam Collins of Movement Capital. How's it going today, Adam?
It is going pretty good.
Good.
Let's dive straight into it. So, first thing off the bat, none of this is investment advice, so don't treat it as such. And for people who have seen some of these webinars before, typically I talk about CoT, but CoT is a report that's released weekly about positioning, and basically since the government's been shut down, they haven't released the report, so there's no new fresh positioning info. But there still is some useful stuff on the seasonality and S&P front. So let's first look at that, specifically seasonality. So the main thing about seasonality that's interesting for this time of year is precious metal strength. You can see in this chart, this is looking at January seasonality over the past 20 years, and it's looking at like average monthly performance. So you can see that the top performers have been platinum, silver, palladium, and gold. And then some of the weaker performers have been like lumber, rice, euro, nat gas, but that's sort of a less of a strong degree of seasonality than precious metals. And in fact, let's dive into the metals. There's sort of been a dispersion of outcomes at the start of the year when it comes to performance. So, for example, copper, more of an industrial metal, has had a strong start to the year. In fact, February and July have been like the two strongest months on average. Gold, sort of a wash start of the year. Palladium, very different. Palladium's just as in 2018, it's been the strongest precious metal so far this year. And in fact, February has had really high seasonality in palladium. Platinum doing a bunch of nothing. Silver, a little bit weaker than gold, but they all have that same typical seasonality, which is January, February strength. You can see it in all these different metal contracts. The main trend, though, I would say, is persistent palladium outperformance, and you can see it in this chart right here. I think it's up like 50% off the August 2018 lows. And so we got precious metal seasonality to be aware of. What else? Maybe in February we got some non-precious metal things. Yeah, so in February, some of the more prominent seasonal trends have been oats have been strong, and we got soybeans have been strong, cotton to a degree. Nat gas has typically been quite weak in February, but it's important to remember when I'm talking nat gas, A, I'm talking Henry Hub, B, I'm talking front month futures. So that's an important caveat. We can look at some other seasonality stats. So let's go into financials. Now, I'll be the first one to say that financial seasonality is probably most relevant for stocks and bonds, a little less so currencies. But for bond seasonality, the main trend is this. Nothing start of the year, strong summer. August has been by far the most positive month for the 30-year bonds, and then sort of not much for Q4. And then going to stocks, obviously, very strong start to the year. We're still within that historically best 6 months period that's defined. I think it's November 1 to April 30. And then with stocks, you typically have strong spring, weak to flat summer, and then very strong fall. Now, obviously, last year was a huge exception, and with all the seasonality stuff, this is more so long-term averages. And I personally think seasonality takes a big backseat to other criteria, be it technicals, positioning, fundamentals. But it is sort of useful to know some seasonality stuff. A non-seasonality thing that's interesting to me is that the momentum for the S&P 500, it flipped negative in early December. Now, obviously, momentum can be assessed a bunch of different parameters, right? Short-term, long-term. I personally look at 12-month momentum. And you can sort of think of that as a proxy for like long-term CTA positioning. So if you've got, positive 12-month momentum, sort of means that like long-term trend followers are biased to the long side, and then vice versa for negative momentum. And the reason I point this out is because S&P momentum 12-month was positive since like June 2016. So it was like steady uptrend, steady uptrend, steady uptrend, trend followers biased long, changed in early December. Now, the last two times momentum turned negative, that was sort of a false signal. That was in 2012 and then also late 2015, early 2016. The whole point of using a momentum framework for stocks is to basically trim equity exposure when the probability of a big drawdown is high. And momentum's interesting in that more often than not, when momentum flips negative, it's sort of the wrong signal. And people mistakenly think, oh, that means, it's sort of a faulty indicator if you're getting more false positive than correct signals. But people are ignoring the payoffs of the probability. So like you can be wrong, 70% of the time, right 30%, if when you're right, it's sort of like an order of magnitude difference than when you're wrong. And so this is another look at that of when momentum flipped negative for US stocks in the 2 prior recessions. And so this is sort of the exact same chart right here too. And so it's worthwhile to note, momentum for US stocks still negative. We came close to flipping positive late last week, but yesterday's drop definitely sort of more so cemented negative momentum. Let's look at some energy seasonality stuff. Let's see. It's honestly most of the same, heating oil, WTI. Obviously, strong starts to the year. And in fact, Q1 has typically been a very strong period for WTI and RBOB and heating oil too, with April on average being the strongest month of the year. And then it's, flip side of that is Q4, which we definitely did see last year. The WTI futures curve is, it's back in just mild contango, sort of outside of the two extremes. Early 2016, crazy steep contango, and then last summer the curve got pretty backwardated. Now it's pretty flat, and so what that means in plain English for those who trade ETFs is if WTI is in a flat curve and you're getting exposure through like USO or these other front month centric products, it's basically not costing a lot of money to roll the exposure if contango is not steep. We can look at nat gas too. So nat gas, you might look at this chart and be like, whoa, all these seasonal averages, they sort of trend down. Why is that? So when I assess seasonality, I'm looking at the seasonality of a roll adjusted position. So, most traders, when they think about nat gas, or most I know there's very specific, energy traders that do a bunch of like deferred stuff and spreading. But when most sort of like macro traders think nat gas, I think in front month, right? And so when I look at seasonality, I'm looking at the seasonality of a front month position that gets rolled. And since nat gas has typically been in contango, which is this red stuff right here, it means that it's sort of, cost traders money to constantly roll that front month exposure. It's been very expensive. And I know Mark Fisher, he talked about it. This sort of led to the huge unwind, last winter, which is a lot of people had to trade on long WTI, short nat gas from a carry perspective because WTI was in backwardation, nat gas is in contango. So there's this sort of like, big expected roll yield to capture. And now that's actually not the case in nat gas. The nat gas, at least on the front part of the curve, is quite backwardated. Let's look at so that's some seasonality stuff. Main takeaways is January seasonality is pretty prominent in precious metals. Get into February, you got some more agricultural stuff. And then I've got 2 other summary graphs for like, here's that momentum stat for everything. And then here's contango backwardation for everything, sort of, defined by that front part of the nat gas curve being in backwardation. But let's turn to some S&P centric stuff. So whenever I think about the S&P, I like to break it down into different elements. So we got, technical, sentiment, rates, macro. So technicals, we already talked about momentum trend. Seasonality, we're still in that sort of like very positive period. It ends April 30th. And what's sort of interesting, I know people sort of, dismiss the concept of seasonality in the S&P, but there's a really interesting paper that's called Our Monthly Seasonals Real, a 3-century perspective. And it looked at seasonality in the British stock market. And it was the same general trend of, strong Q4, strong Q1, weak Q2 and 3. Just thought it was interesting. We got FOMC drift. We've got buyback blackout. So this is quite relevant right now. We are in the blackout period for most companies leading up to their Q4 earnings announcements. Now, it's important to note that this period, it's not like some big thing for the entire S&P. It's very company specific. But as we all know, companies sort of announce earnings in waves. And so these periods I've defined as these like, multi-week blackout windows. It's sort of the concentration of companies, leading up to when most companies announce. And for some companies, their blackout window is 5 weeks pre-earnings, and so that's what these date windows capture. And we're in that period right now, and we actually come out of it January 25th, so very soon. Meaning lots of companies are ramping up reporting. Margin debt. This is pretty interesting to me. So when most people think about margin debt, they think about these big scary numbers of investors have 600 billion of margin debt. And that's interesting, but I care more so about the rate of change. Basically, are traders leveraging up or deleveraging? And you can see historically, what's mattered more is not so much the absolute level; it's the rate of change. So if this graph is green, it means that margin debt is rising year over year. If it's red, it means it's contracting year over year. Like right here, for example, December 2001, over the prior year, margin debt had fallen by 39%, aka traders were deleveraging in their accounts. And the reason I'll point this out is because now margin debt is contracting. It's contracted by 5% over the past year, and actually a little more because I think fresh data came out recently. And so this historically has not been a good thing. You can see the blue line is basically only having S&P exposure when margin debt is expanding, and that's historically, hypothetically outperformed buy and hold. So it's something to keep an eye on of if traders are sort of ramping up leverage, especially like right here, or if they're deleveraging like they are now. Sentiment, everybody knows sentiment, pretty much a washout. People got super pessimistic, especially in AAI. So the spread between bulls and bears got to those, early 2016 extremes. I sort of thought it was interesting that name didn't. So this is an exposure index that sort of polls active money managers and says, hey, what's your desired exposure to S&P right now? Really high, really low. And when the exposure index is low, it sort of means people are skittish, not running a bunch of long exposure. And we got down to here in late 2015, and basically this indicator, it didn't really get as pessimistic as it was back then. We got put call ratios. Past couple weeks, they've definitely come down as fears receded as the market has rallied. Spot VIX, the futures curve. I don't know what I didn't check on it yesterday, but as of last Friday, it was in just a mild amount of contango. And this sort of gets back to, I was talking about contango and backwardation in commodities. A lot of volatility traders use the VIX futures curve as a way to either be long or short vol, meaning that when it's in contango, people like to be short vol. When it's in backwardation, some like to be, biased to the long side. And so we're in more contango right now. So you probably had some vol traders dip into the short side. Rates. When it comes to looking at interest rates, I like to look at how the yield curve has shifted. So not the absolute level, but how it's shifted. And a lot of people think rapid flattening is bad. And I sort of disagree with that. I think that because you've probably had people on that talk about the different lead lag times between yield curve inversions and recessions. It's hit or miss. Sometimes it's 6 months, sometimes it's 2 years. And so for me though, when I think about a yield curve, I think about, okay, is it rapidly steepening? And it sort of sounds counterintuitive, but think about this. In prior recessions, in any recession, basically, what does the Fed do? They come in, they massively lower short-term rates, right? That typically causes the curve to rapidly steepen. As short-term rates drop quickly and long-term rates sort of don't drop as quickly, right? And so you can see that over the past 25, 26 years, whenever the 10 and 2 Treasury yield curve has rapidly steepened more than like 50 basis points in 12 months, which is when this graph is red, historically, that's been a really bad time for stocks. And we're not there right now. In fact, this section of the curve is flattened by 41 basis points over the past 12 months. High yield spreads, this is noteworthy right now because while high yield spreads, they've come back down from their late December highs of like 550 or so over treasuries, they're still greater than their 12-month average. So high yield spreads have been sort of blowing out over the past 12 months. Sort of, maybe blowing out is the wrong term, but definitely rising. TED spread, people use this to sort of figure out, hey, is there stress in the banking sector because it looks at 3-month LIBOR relative to 3-month treasuries, and there's not. So TED spread is quite low. There's no risk there. U.S. macro picture is still strong. Obviously, people have pointed out that housing, not so. We've had some really bad housing data. But if you look at, retail sales, PMI. I know PMI's come down, but any PMI north of 50 is still indicating expansion. Now, I will say this is U.S. centric economic, information. International stuff has been quite ugly. Here's one thing I'm watching for. So with that last jobs report, it's a very strong jobs number, but the unemployment rate ticked up from 3.7 to 3.9. Historically, an increasing unemployment rate is a bad thing. So we're not there yet. And when I say increasing, I'm just talking about current unemployment rate relative to 12-month average. So we're not there yet. The current unemployment rate of 3.9 is directly equal to its 12-month average of 3.9. But if we were to see the unemployment rate, steadily tick up, like into the fours or fives, that would be a really bad sign for me. Because think about what it means. Okay, unemployment rate is rising. People are losing their jobs. That means they probably have less money to spend. Our economy is so consumer centric. Less people spending money equals higher probability of recession. And so, high unemployment rate or weaker labor market is a negative thing. I would definitely keep an eye on if the unemployment rate continued to rise. So overall, I hope that was a helpful, summary of seasonality and some S&P stuff. And if anybody's got any questions, I'm happy to answer them.
Yeah, great information. It's been quiet the past few weeks without getting your CoT update. That's still, so there's no update on that. Basically, when the government starts up again, that will start up. Is there any idea how it's going to roll out? Will they update the past few weeks or just start with what they have?
I'm going to assume that they're just going to give us the most recent week. Somebody actually asked me this last night, and I need to go look into it. But the reason, well, this is sort of the interesting angle of it, is we have had prior shutdowns, right? And if I remember correctly, because I've been doing the CT stuff for a while, it's never actually interrupted the release schedule. So it's sort of like, during a shutdown, we've kept on getting the info. And so yeah, it's I'm going to assume that when they start re-releasing, we just get the most recent. But I do hope that they sort of give us a big data dump when they restart.
Yeah, well, part of it comes as the longest shutdown ever, so we've never really in uncharted territory.
Yeah.
What signals are you looking at right now? Like you brought up that yield curve flattening and how there's certain times in the past it's brought up tumultuous signals for the equity market. Is that something that, where does that stand right now?
Okay, so I sort of define it as like a no worry. So like a lot of people have been freaking out about the yield curve in terms of it's quickly flattened, et cetera. And that's sort of looking at an absolute yield curve. You're looking at, what's the current difference between 10 and 2. I like to look at how that difference has shifted. And so what a lot of people intuitively think is that a quickly flattening curve is bad for the S&P. And the data is pretty clear, and that's not the case. What matters more, and the issue with it is because you can have a yield curve, quickly flatten, but then it has this, super variable lag time to when the market actually cares. So you can have an inversion and then a recession 6 months later or 2 years later. There's almost no rhyme or reason to the time between the two. What I've personally found that is more interesting is not if the yield curve is quickly flattened, but if it's quickly steepened. So if the spread has quickly increased between the 10 and the 2. And so the way I assess it is looking at the 12-month change in that spread. And if it's steepened by more than 50 basis points, historically, that's been a bad time to get long stocks because it's coincided almost directly with the two prior recessions. Now, obviously, there was a false signal in 2013 when we had the taper tantrum and long-term rates really came up. But right now, when it comes to like the way I look at the yield curve, a quick steepening, we definitely haven't had that. And so that's how I think about it.
Okay. Now, we haven't had the CoT data for a number of weeks. What do you get the sense, though, based on the last data we've had and then obviously the volatility across all asset classes, where do you think the crowded positions are right now?
So what is sort of interesting, I'll pull up the CoT website, is that as of the last report, it was late December, right? And if you would have told somebody,
Nat gas was, I think, one of the large longs.
yeah. if you would have told somebody in late December what was sort of the current spec positioning in equity futures, I can assure you people would have assumed, oh, they've quickly pulled longs, right? This has been horrible price action, et cetera. The most interesting thing is that in the S&P, you can see this going from November to December, traders actually got more net long. So it was completely opposite. And so once we get this fresh data, I'll be really interested to see if within January they sort of, ran with that stance and just ramped up long exposure even more so because they got rewarded for it, or if they took January's rip as an opportunity to sort of pare down some of their still substantial long exposure. And I know this is a 5-year percentile, but I also like to look at like dollar exposure, and specs were net long, like if I remember correctly, like still net long 50 billion as of December 21st. And the nuts thing about that is, a lot of people compare recent price action to the analog of like late 2015, early 2016. But back then, positioning got far more pessimistic way quicker. In fact, specs got net short like 20 billion. And so as of, who knows since, but as of late December, traders were positioning super differently in the E-mini contract than in sort of like previous big corrections.
Yeah, Larry's been talking about that as well. He has a similar sort of thought that you were just mentioning on that. Somebody's asking a question: has no CoT report changed or affected your trading strategy at all?
For me personally, no. So I actually am in a lot longer term than like these sites imply. These sites all stem from the fact that like I worked for a fund and I developed some resources and I thought the resources were cool, and so I sort of spun them out into a free thing for people. Like the way I actually invest money through movement capital is a good bit slower. In fact, it's sort of with the frequency of the simple stock model website when it comes to sort of more weekly, monthly stuff as opposed to intraday or daily. And so for me, my main inputs are how much equity risk to have, and then what governs that. And I sort of care about the trend of markets, the probability of recession, if it's sort of cheap to have tail risk at hedge exposure. And so for me, CoT doesn't really impact my sort of stance on equities. I care much more about economic indicator stuff and technicals. And so it hasn't, negatively impacted me in that sense, but it has been unfortunate in that, like, if you've got a model and it says to be running long S&P, you want to look at CoT, and you definitely don't want to see a crowded long there. So it's a helpful sort of gut check for if you're actually a contrarian or if you really are running with the trend. And it's been lackluster not to have sort of that backup info since.
Yeah, great answer. All right, that's about all the questions. I really appreciate you taking the time. You can find more information from Adam at his website, movementcapital.com, and commodityseasonality.com, market COT. What's the COT one?
So we got commodityseasonality.com, we got freecotdata.com, and then we've got simplestockmodels.com. And then one other thing I think any subscribers would find useful. So one thing I've started doing is, like, for interesting books I've read, writing like a summary or like a takeaway document. And I read this book a couple weeks ago from this really interesting guy that he was a trader, and then he sort of went into biology and to sort of figure out, hey, in the minds of investors and traders, how does their hormonal profile sort of affect their decision making? And anyway, so I wrote this article about like what I learned from it, and it's got a ton of interesting studies where he looks at like morning testosterone levels relative to like afternoon P&L, and it was a really like fresh look at the mental side of trading. And this is just a free article, and if anybody
what website's that on?
So I actually just posted it as a blog post on this website called Medium. But like if you Google something like if you Google like Adam Collins Medium, it should be one of these. Yeah, it's like one of these first links. And so it was a really interesting book, and I think any trader or investor would find it worthwhile to read.
Nice. Yeah, great information. And you can also check out his Twitter feed. I saw that, I don't
Oh,
think it
yeah.
was that book, but I saw that you were taking some pictures of some really interesting pages in some books.
It was this book actually.
Oh, that was, there was something
Yeah,
about,
yeah.
so all the pages that you've posted have been from that book. Yeah, it was talking about, I think it was the long-term capital management blow up is the page that I
Oh
was
no, no,
referring
no,
to.
you're right. That book, you're right. That book was called Crisis of Crowding, another great book. And it was by a guy who in some way he was affiliated with LTCM, but the book basically breaks down different crowded trades. It's actually quite relevant to CoT. And it breaks down the exact positions they had, how they went awry. And if anybody's interested in like market history, they got to check out that book. It's really good.
Yeah. All right. Thanks a lot, Adam. We'll talk to you later.
All right, cool.